you don't have to swing at every pitch. Sometimes we get into this mindset that when we're analyzing a business, what if I'm spending all my time looking over here when the choice to my right is, going to be the one that could set me up for generational wealth. And that is unfortunately part of the gig of investing in the stock market is you can't invest in everything and you have to choose your battles. And so
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
Starts now.
All right, folks. Welcome to Investing for Beginners podcast. Today, we're going to answer a listener's questions. We got these great group of questions from Bruno, and we're going to go ahead and answer these on the air. So we'll just kind of work through them as we go. So here we go. So we got, good morning, gents. Just listened to the stock crash episode. Super helpful and learned a ton about Fiserv. So the first question is, I am still learning how to invest in long-term. With the fundamentals, I almost don't trust myself to rely on what I find in reports to feel confident in investing in companies. What else should I be looking for? Fantastic question, Bruno. So here's our answer.
Oh, yeah, here's the answer. We could spend an entire episode on this. So yeah. I love it. Thank you for writing in, Bruno. This is awesome. Yeah, like looking at fundamentals, there's so many fundamentals you could look at. There's so many metrics. There's everything. It can be hard to get to a place where you feel like, okay, I know enough to feel confident. And the first thing I would say is it is not something that I would worry or try to worry about getting to overnight. Picking stocks is a long journey. And, I'm the type, I have the personality where when I go after something, I want to have it all figured out. I want to have it mapped out. I've got day 1 through 365 all mapped out. I know exactly what 365 is going to look like. We can all laugh about that now because we know that's not how life works. And so just because you might buy something and then the way that you analyze a stock changes in 6 months, that's not necessarily a bad thing. It's a learning process. With all that said, for me, one of the great filtering tools that really helped me out as a beginner was the price to earnings ratio. The reason for that is that it can take away a lot of landmines out of your portfolio, out of your picking, your stock picking, and that can be a great way to just avoid a lot of heartache in the early days. So price to earnings ratio, it's on most financial websites. If you pull up a stock ticker, price divided by earnings, the lower the number, the cheaper a stock is compared to its earnings. And so if you can not only use a filter like that, but start to layer multiple filters, you can reduce the number of stocks you're looking at. And that can help you feel a little more confident. Maybe it's like, okay, maybe I've used 3 or 4 filters, and so I have a group of like 10 stocks. Maybe not all 10 of them are going to be winners, but maybe the group of 10 as a whole is on average going to do better because I know these 3 metrics help me find better companies. That's I think a nicer way to look at it. That okay, it's not a guarantee that I'm making the right choice, but at least I'm starting to stack the odds in my favor. And that's really all you're doing when you're looking at fundamentals anyways. No perfect measurement of fundamentals is ever going to help you find the perfect stock because there's no such thing as the perfect solution in the stock market.
No, and that's the challenging part of investing is that there's no one size fits all. There are so many different shapes and sizes to think about when you're investing, and that can overwhelm and make people feel like they don't know what they're doing because there's so many different options. And I think the idea that Andrew was espousing about looking at the PE ratio and using several different filters to try to narrow the companies you're looking at is a fantastic place to start because I think when you start to narrow down your choices, it makes it easier to make choices. As someone who worked in a restaurant business, I have found that when you go to places, and I also observed by experimenting, when you go to places and they have a bazillion different things on the menu, it's really hard to make a choice. And you feel like you're not making the right choice, or you start hesitating because you're worrying that I'm not buying the right thing or that kind of thing. And I know that that has been a complaint about businesses like the Cheesecake Factory, which has a, one of the largest menus you're ever going to find. I've heard people complain about Taco Bell and that their menu is too big. There's too many choices. It's hard to make decisions. One of the easiest shifts I've ever worked in my entire restaurant life was a super, super busy night that we gave the guests two choices. They got two things for a salad, two things for an entree, two things for a dessert, and that was it. And because we narrowed it all down, the decision making on the guest part was so much simpler, and it was also easier on the kitchen. So anyway, all that to say that narrowing your choices can help you make decisions. I guess the other thing that I would think about too is when you're worrying about missing things, a couple things kind of spring to mind. Number one is you don't have to swing at every pitch. Sometimes we get into this mindset that when we're analyzing a business, what if I'm spending all my time looking over here when the choice to my right is, going to be the one that could set me up for generational wealth. And that is unfortunately part of the gig of investing in the stock market, is you can't invest in everything and you have to choose your battles. And so I think once you figure out what your style is going to be and kind of how you want to invest, that can start to help, again, narrow your opportunities or your choices. The second thing I would throw out there for Bruno and anybody else that's kind of feeling like this is we recently discussed the use of a checklist. This is where having a checklist can be crucial, critical, assign whatever adjective you want to this. A checklist can help you start to figure out, okay, what am I missing, or how can I trust myself? Well, when you know that your benchmark for a return on invested capital, for example, is 15%, and you look at a company and it's coming in at 8, okay, fine. I'm not missing that because I can trust myself that I know this is what I'm looking for. And part of the challenge, of course, is setting up the checklist. We have one for you. You could start with to use as a template, and then you can adapt from there. Follow your favorite investors. See what kinds of things that they hang their hat on as far as numbers, revenue growth at this, and margins at this, all those kinds of things. You can kind of adapt to the different kinds of companies that you're going to encounter in the market. But going back to having a checklist, even if it's only 10 to 20 questions, not a lot, can be super helpful in helping you gain trust in, okay, I'm learning this about this business, and these metrics tell me this. Okay, I can trust it because I know I've used it in the past. Other people have used it, and this has been successful for other people. And this is where having a checklist can help set aside some of those doubts and fears of missing out or making a mistake because you missed on something. It helps narrow the mistakes that we could make. So that's what I would tell Bruno, that if we were having a coffee together or a beer, to look at a checklist and try to follow one.
Yeah, absolutely love that advice. One other idea just kind of pops in my head. You have the numbers, you have the fundamentals, you have the checklist. Those are all great things. Maybe try picking an industry that doesn't have as many people. Maybe there's 3 or 4 major players in the industry. We kind of made the question a little shorter, but Bruno mentioned how he's listening to earnings calls and things like that. Maybe pick a small industry, listen to all the earnings calls for everybody in that industry, and then see what your favorite company, like favorite as in what company do you feel most confident about after analyzing all those options. So rather, again, trying to limit the playing field, do I feel confident in my ability to at least compare competition? Because in my mind, that's an easier hurdle than trying to say, is this the best stock in the stock market out of 19,000 other options I have today. It's easier to say, is this, is Chipotle the best fast casual restaurant? Or is McKesson the best medical distributor? Those decisions, I think, are easier and can help you feel confident about not only yourself, but also the businesses you're investing in. And that's what it's all about, being confident both in yourself and the businesses you're investing in. That's a magical, powerful formula to have, because then that can, if you have confidence in the businesses that you're investing in, you know that they're going to outperform their competition. They're going to do what it takes to be the best or to hold their ground in their industry. Then you can know you're probably going to get a great result from that, if you pay the right price. And then just obviously, I think being confident in yourself and your abilities and your judgment is, that's obvious too. But maybe try that. I don't know. I haven't done that intentionally where I'm like, I'm just going to pick an industry. But I know there have been times in my journey where I was like, you know what? I want to have some exposure to insurance, for example. So let me see if I can find my favorite one and then run the numbers and see if the numbers still come out okay. And that could be another way to get to maybe where you're trying to go here.
Yeah, that's a fantastic decision or a suggestion, because again, it helps you narrow down your focus, and it also helps you really learn that particular sector or industry really well. Which even if you decide that maybe these four companies are not ones you want to invest, it's also more knowledge that you've gained, and if you ever have to come back to that industry or sector, that's knowledge you've already acquired. And so you don't necessarily need to require all of it. You may have to brush up on, if you're older like me, you may have to brush up a little bit more, but you'll still have to, you won't have to do as much of the hard work. So I think that's a great suggestion. All right. So let's move on to Bruno's second question, which is, what are your thoughts on investing in ETFs like the S&P and QUTM or Quantum? So what are your thoughts on this question?
Yeah, another great question. I really believe it depends on what ETF we're talking about. I don't know. There's pros and cons to ETFs. I love the S&P ETF. I would recommend that for most people. It's just, you set it and forget it. As long as you're confident in yourself and you know that I'm not going to touch this until I retire, and I have multi-decades until I do have to retire. That's easy. It's a slam dunk. Just don't freak out if the market goes down, because you know that that's what it's supposed to do. What are your thoughts on QTM?
That is, I think, probably a different beast. You were talking about the companies that were kind of under the hood of this ETF. And that has a big bearing on any ETF that you're going to invest in. You have to know what's in it. Like the one that Andrew was talking about a moment ago, the S&P 500, whether that's the Vanguard one or the myriad of other ones that you could choose from. Those are all a collection of the 500 top businesses in the United States. They're all put under one ETF. And that's a fantastic way to just invest in the economy of the US. And it includes, all the big names that we're all familiar with, NVIDIA, Amazon, Google, Netflix, Microsoft, Amazon, Meta, the Tesla, the line, it just goes on and on and on. Anyway, so that, what's under the hood for that. When you're looking at any other ETF, that is very important to understand what's under the hood, because that's obviously what's going to drive the returns on the ETF. Now, my first blush when I first looked at quantum, the first thing I saw was talking about quantum computers, and that to me kind of was like, and that was like a kind of a hard pass, no, simply for the fact that I don't know a lot about quantum computing. Frankly, I know very, very little about it, other than it's a different way of of running a computer, and that it's still in the early innings of this technology, and the early returns look like it could be quite promising and could be a pretty amazing breakthrough in how we figure things out, how we answer questions and whatnot. But it's very, very early innings. And a lot of the companies that I've seen bandied about into this particular thing aren't even generating revenue and already have, billions of dollars in market cap, because people are in essence gambling that this is going to be the next thing. And it very well could be, but we're so far away from whether this is going to pan out or not. So to me, it's very much speculative, but I will quantify that by Andrew took a moment and looked at what was under the hood, and maybe you could share some of the companies and we could talk a little bit more about that.
Yeah, some names I'm not familiar with. I'm just going to list some of the ones I am. Tower Semiconductor, Intel, Oracle, Baidu, Alibaba, MongoDB. So you got semiconductors in there. You have a cloud company, Oracle. Baidu is Chinese e-commerce or something. Not super familiar with them. Yeah. MongoDB being a cloud. So yes, the name of it is Quantum, and I didn't recognize the top two holdings, who those companies are, but each of the position sizes are pretty small. So the biggest one was maybe like 2%, and a lot of them were around 1% position size. You're buying this, you're not getting a huge exposure to Intel if you hate Intel, for example, or Oracle if if you think Larry Ellison's the worst human being on the planet. It's not a major allocation there. But yeah, it is interesting. Like I would have thought that it would have been kind of to your point of all these speculative non-revenue names, but these are definitely names generating revenue at this time. Some of the bigger ones,
for sure. Yeah, for sure. And the thing with a ETF like that is, you just need one of these companies to do well, and then the ETF can do well for you. I think when you're thinking about investing in these different ETFs, I think you have to, the way I would try to approach it or think about it would be, what are my expectations for this? Why am I buying this? And what am I hoping to get out of this? And so whether it's something air quote more traditional, like, the VTI or SPY that focus on the S&P 500, or whether you're looking at something like Quantum, or whether you're looking at something like that focuses on the airlines, or focuses on the Carnival, the cruise ships, or focuses on cloud computing or semiconductors. There is a gazillion of ETFs out there, and you can find anything that you want to fit your flavor. So if you're going to invest in something like a Quantum, you have to understand, what am I trying to get out of this, and what are my expectations, and also what is your time horizon? Are you expecting this to do really well in the next year and then dump it, or is this something that you expect to hold for the next 10 or 15 years? And that sets up different expectations. So that's kind of how I would try to approach looking at these kinds of investments. And to your point earlier, Andrew, I think S&P 500 is kind of a no-brainer for most people. And something like Quantum, I think I would probably put on more of the speculative bandwidth, as I wouldn't put 50% of my money in it, but maybe throw in 1 or 2% probably wouldn't be a horrible thing. So I guess that's kind of how I approach it. What are your thoughts on any of that?
I completely agree with you. It's funny, like you mentioned how some of these are not generating revenue. I'm getting Nikola. Was that the company, Nikola Vibes? They crashed and burned. Similar story where they IPO'd and did not have revenues. So yes, there might be, quantum computing could very well be the next big thing, but we don't know who the company is at this time. It could be Google, could actually take a lot of this. Or it could be one of the companies in here, and this ETF could have been the greatest thing you bought in your time machine going 20 years out. it's just a hard game. And you know what makes it hard too is there are so many ETFs coming out now, like so many flavors. The flavors just keep multiplying. Like it's not the barriers to entry to make an ETF are not huge. And so there's a lot of ETFs out there. And so it's funny that a product vehicle that was supposed to make investing easy is kind of hard in a way because you do kind of want to know what's under the hood. But again, that's a lot of overthinking for something where if we're just talking about throw a couple percentage points at it and just call it a day, that could be fun too. So I just love to overthink things and really dive into the weeds on stuff. But yeah, for your general investor, having a percent or two in a thematic ETF, I think is awesome.
Agreed. Great question. All right, let's move on to the last question. So my goals are like most others. I want my portfolio to set me up long term so I can buy a comfortable home. I partially listened to your housing episode with interest rates on savings. He asked, but are there ways to leverage my portfolio when taking out loans for a home? So this is an interesting question, and I'm curious what your take is on this.
Yeah, I think we're starting to breach into high net worth type of strategies when you talk about using a portfolio for collateral for loans and things like that. And so I would just say it's out of my circle of competence. I would probably talk to your private banker, and he could educate you on the ups and the downs. Let's just keep in mind. We grew up, I'm putting that in air quotes, we grew up on like Warren Buffett, and I grew up on Dave Ramsey, two guys who are very anti-debt. And so Warren Buffett was somebody who showed that you could build wealth without the whole debt spiel. A lot of people make a lot of money with debt, but a lot of people also go bankrupt with debt like Dave Ramsey did. So he's very anti-debt now as well. So I don't know, like the overthinker in me really gets excited about the idea of squeezing out basis points here and there and, using collateral and all these things. That's the overthinker, that's the CFO, that's the maximizer, that's the optimizer. The other part of me who's been able to observe other wiser people who talk a lot about debt kind of says, you know what, there are always instances that we are not prepared for, that are unprecedented, that are black swans, as Nassim Taleb calls them. And so respecting that, you have to be very, very careful with debt. And even there are people who are anti-debt and they become very wealthy despite not taking advantage, in air quotes, of all the leverage opportunities with debt. So long-winded answer. Obviously, there's a lot of ways you can go with that, but that's kind of what I think. Do you have thoughts as well?
I have similar thoughts. I would agree with you. In the whole investing world, we've cut our teeth with Warren Buffett and Charlie Munger and people of that ilk, and they have been very anti-debt along the way, and they have felt that it can lead, it can lead to excess and ruin, and if not managed properly and correctly, and understanding the tiger that you have by the tail, so to speak, it could really come back to be very dangerous and detrimental to your fiscal health. That being said, we've also learned along the way, I know I have, that debt is not the ultimate evil that I kind of felt like it was at the beginning of my investing journey. I've come to learn that there is, as always in finance, nuance to how these things are done. And yes, I would agree that the idea that using leverage on your investment portfolio to take out loans for a home probably sounds next level to me, and is not something that I have any experience doing, and I'm not in a position to do. And so this would be something that if somebody came to me on the street and asked me my opinion, I would say you need to go talk to a financial advisor or somebody that has some education in this realm to help you out with this. I think there can be circumstances where using debt to help you do some of the things that you want to do, depending on how long it's going to take you to pay it back, how much it's going to cost you, what the rates are that you're going to pay on this, all should have a bearing on how you do this. Because if, to Andrew's point, a black swan comes along, i.e., COVID, or something related to that none of us, have on our bingo cards, that can be quite a shock, and it can be very, you could lose your home. Think about how hard you work for your home, how hard you work for your portfolio, and then something like that happens and you lose both. Then that could be very, very detrimental. I'm assuming that Bruno is not talking or is not referencing using leverage like hedging, where you're trying to take, out 2 or 3 times on your portfolio to using debt to boost your returns so that you can, earn more money and then turn around and use that to buy a home. That is playing with fire. I would strongly encourage anybody that's thinking about that, do not do that, please, 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 because that has potential to be very, very dangerous. And so I guess my point with all this is that while there can be some opportunities that can help you, I think to Andrew's point, I think you really need to think about how you're going to use it and have a plan. As our friend Evan would say, have a plan on how you're going to pay this back and when it's going to be paid back and how much this is going to cost you in the long run. And is that the best way to do it? There may be circumstances and times where it may be, and there may be others when it's not. And so just understanding those ins and outs, I think, would be very, very helpful to determine whether using this kind of opportunity to buy a home would be a good idea or not.
Yeah. And actually, if you listen fully to one of the episodes Evan did, which we should probably link, but he mentioned, and you guys were talking together actually, mentioned how property taxes ballooned. I think you said in Iowa, right? Where you lived.
Minnesota, where we lived.
Oh, yeah. Minnesota. Yeah.
Yeah.
And so Evan mentioned that if you have a certain plan or a certain way that you expect an investment to go, and you don't leave wiggle room in your investment plan, and I'm putting that in air quotes, you could really leave yourself in a situation that leads you to be susceptible to Murphy's Law, for lack of a better explanation. It is plan that, going back to like that phrase we love to use, margin of safety. If you're gonna do the numbers and all that, like I like to do, leave a margin of safety and try to do it as intelligently as possible.
Yes. I think that's probably the key, right? If this is something you want to do, try to do it as intelligently as you possibly can. Do not just rely on one person. I probably would recommend getting several opinions before you proceed with something like this, to make sure that you are approaching it from the best angle that will work the best for you. And I think if you do that, then you're making an informed decision and you're doing what you think is the best thing to do. But always have a plan. What is it? What is that phrase? Those who fail to plan to fail, kind of thing.
Mm-hmm. Mm-hmm.
So
yeah,
I know that applies to military battles, but it also applies to life and finance as well.
Hey, finance is a battle too.
Yeah, true.
My algorithm did uncover this thing where they called the whole rich getting richer by leveraging debt and their stock portfolios, their stock holdings. They said it was like infinite money. And I was laughing because the comments were sharing how that's clearly not the case. Like there's no infinite money glitch if you have a big enough portfolio. There are other things that can happen other than just everything working out for you. So I thought that was kind of funny.
Yes. And, as an Irishman, we fully respect Murphy's Law. And we understand that it does happen. It is real. And you need to understand that it has an angry bite. So just always keep that in mind.
Why is that? Is there a little mini history lesson in there for all of us?
Well, the history of the Irish is, the luck of the Irish is, I think the best way you can describe it is the luck of the Irish is to win the lottery and die the next day. Like that's the luck of the Irish.
Okay. All right.
And so when you think about something like Murphy's Law, it's, if something it could go wrong, it will go wrong, kind of idea. And that always seems to be kind of the way that the Irish have had the luck of.
Gotcha. That explains a lot. My little 1/16th Irish. Dang it.
Right. Yeah. Wah, wah. Sorry.
Well, you know what? The other thing we can say is we broke another rule today.
Oh.
First time on the podcast. We don't talk about Bruno. Today we talked with Bruno. So
oh man.
There you go.
Oh boo. That was you just had to go there, didn't you?
I sure did. You're welcome.
You're welcome.
All the people with no kids are just like, what are they saying right now?
Disney. Why do they keep referencing all these Disney things? Like, what are they? Okay. All right. Well, with that, folks, we will go ahead and wrap up our conversation for today. I want to thank Bruno for sending these fantastic questions. These are very thought-provoking, and hopefully we helped answer some of your questions. If you have any questions like this, please do not hesitate to reach out to us. You can send us questions at newsletter@einvestingforbeginners.com. That is in the show notes, so you can easily reach out to us. Or you can send us questions on the X Machine or the LinkedIn Machine as well, or on YouTube as well. So there's lots of places that you can reach out to us if you have questions, and we're happy and dying to help you out. With that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.